All right, good morning. This is Mike and Corey today. And today we have some exciting topics. We are going to talk about Generation X, which I'm in, not Corey, but Generation X approaching retirement and how that looks. We're going to talk about Peloton. Some of you may be watching this, you have your Peloton. Hopefully you're working out while you watch it, but more likely maybe your Peloton, you got stuff hanging all over. It's like a storage device. You got clothes hanging off of it. Maybe not. And then Corey's going to talk about shareholder yield. And I know before he talked about a yield trap, but he's going to talk to you more on the positive side of it, not the yield trap. But before we get started, I must remind you, this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So let me share my screen. I'll briefly show you today's market. It is what I'm going to call neutral. I mean, Dow's down a little, S&P's up a little, NASDAQ's down a little. Nothing really exciting to call out right there. So I'm going to dive right into Generation X. This article's in the Wall Street Journal. Generation X approaches retirement. Reality still bites. It's a playoff of an old movie, Reality Bites. The forgotten generation, 1965 to 1980. If you were born in that, you are considered Generation X, of which I'm in. This scares me, this first sentence. The oldest members of Generation X are turning 60 next year. Wow, that part scares me. The second part, many can't afford to stop working anytime soon. That doesn't scare me as much. But anyways, my generation is turning 60 next year. I am not turning 60. I'm not the oldest member of it, but it's coming. And so from age 60 to 70, there's some key things within your retirement planning. When do you take Social Security? How does Medicare work? Are you actually going to stop working retirement-wise? What's your spouse doing? How do I access the dollars that I've saved? Lots of things come up in that 60 to 70 key decisions to be made that we certainly want to come alongside and help you with. But here is the gist of this article, and this really is pretty interesting. So Generation X, we were in a crossover period. So when we started in the workforce, that was when there was things like pensions. There was defined contribution plans. And I remember working at different companies and there was pension plans and they talked about it when you did your first meeting with HR. But by the last 20 years, pensions are almost gone. Yes, there's still some pensions out there for the military and teachers, and there's some other pensions. But for the most part, pensions have declined. And I'm going to show you a graph that shows that. And now it is all 401k, put your savings in there, get your match from your company. That's the way it is. But Generation X was in a crossover period. So they started with one and they ended with another. And I want to, this graph here really kind of struck me right here. So you can see on this graph on my screen, the decline of pension plans from 1975. And it's kind of the lower one that goes down and to the right. Those were pensions, defined benefits, I should say. And then the up and to the right is defined contribution. So when I first started at an old company that had a pension, they would say, yeah, if you work here for 30 years and you're 55 and blah, 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 you're going to get $3,000 a month or whatever the number was. We knew what we were going to get at that time. Nowadays, you just know what you put in and then you don't know where the market's going to take it. So it feels like there's more unknowns, but there's also a lot more control by you. You're not waiting for a company to invest your money. You're doing it yourself, hopefully with people like us that can help you with that. So one of the other things in this article they talk about, and I'm going to scroll back up, is that Generation X is financially worse off than their baby boomer predecessors. And the way they're looking at that is by medium household net worth. So they're looking at it a couple years old, but they're saying, Gen Xers, it was averaging $250,000, which is 7% lower than baby boomers at the same age. And they're using inflation adjusted data, thank goodness, so that they can kind of look at an apples to apples comparison. 7% lower is not a lot, but when you consider that they don't have a defined pension, a defined payment coming, it really is a lot lower. So, and then there's always a concern on whether Social Security is going to pay out. So if you find yourself in Generation X, born in 65 to 1980, you are in this. Retirement, at least the consideration to retirement is coming soon. So I thought this was an interesting article, not all negative, but certainly a lot more responsibility for building your own retirement plan. The other part of getting older and getting closer is exercise. So, Corey doesn't have to worry about it. He's just naturally fit. He's young. He can get around. But some of us have to get on the exercise bike. And if you remember,
Mike, that's not what my wife says. I don't know. I do appreciate you saying that though. I'll tell her. I'm gonna
you know
tell her.
what? I just had a great business idea. Exercise plans built by spouses. There we go.
Whoa.
Don't worry about what you think you need. Listen to your spouse. They'll tell you what exercise you need.
Hey,
I don't think.
I've known some people who try that and they end up needing counselor afterwards. So you could be boosting some counselor visits as well.
Oh my gosh. Well, if you remember during COVID, if you can remember all the way back in COVID, there was a big surge where we couldn't go to the gym anymore, so it was time to go out and buy that exercise bike. And no one benefited more by this than Peloton. Well, Peloton earnings came out today, and look at the headline. Peloton shares up more than 15%, and it's way more now. It is up 24% today. And you're like, wow, Peloton is really kicking butt. They're blowing it out. We should be in Peloton. No, no, no. Let's be careful. They returned to sales growth for the first time in 9 quarters. So that means decline for 9 quarters in a row, and it gets low enough and they finally can turn a corner and be ahead. So that's one part of it. And you say, wow, 24%. I would love to get 24% in a day on a return. Well, let me show you. Let me show you their graph. So I'm going to show you their 5-day graph that you'll be like, man, I wish I was in this stock at $3 a share, and now it's up to $4.17. But let's look at the true story. Let's roll it back. Here's their 1-year chart, and you can see, well, they've been as high as like $7 a share. They're up to $4 again, still down. And here's the real painful chart. Let's look at all the way back. You see that big surge, that camelback spike right there to $150 a share. And I got the premise of this company. Let's sell $3,000 or $4,000 treadmills and exercise bikes. Let's do things online and let's charge our clients a $40 a month subscription or whatever that costs. And we're going to get continued revenue. That has not worked well. And you can see that if somebody bought that stock at $150 a share, hopefully they sold it at 140 and only lost a little. But if you bought it back then and you held on to it, you are down whatever 90 some percent. It's ugly. So just because the stock is up 23% does not mean like rush out and buy it. It's not. I do not see any indication that it's going anywhere close to where it's been. I do wish the company the best, and I'm sure the treadmills are fantastic. I personally go to the gym, and they have all the treadmills there that we need. And guess what? When I get tired of being on a treadmill or a bike, I don't own it, and somebody else can use it. So, whereas when you put it in your house, you're paying a lot of money for something that only you and maybe your spouse are going to use. So, anyways, I just thought it since Peloton's in the news, you might be interested. But let me turn it over to you since I know this stock doesn't yield anything but pain. I'll turn it over to Corey, and he'll talk about real shareholder yield.
Hey, thanks, Mike. Yeah, I wanted to look here at I came across this ETF earlier this year. It's called the Cambria Shareholder Yield ETF. And it holds only companies that have high shareholder yields. So kind of interesting there. What is a shareholder yield? So a lot of us are familiar, and some not even, with a dividend yield. But a dividend yield is kind of that first yield that you'll learn about as an investor. And a dividend yield can make you feel good because, if you own a high quality company, high quality stock, and they pay you some of their earnings as being a part owner in the company, it feels really good. And you feel like, okay, maybe I don't need the stock to go up quite as much because I'm going to get paid along the way. And that is an important thing to be mindful of as a shareholder. And of course, you always want to own high quality companies. There's a few other ways, though, that companies can pay you as a shareholder, even though you're not getting the check. So one of those ways is buying back stock. So you can see that down here. That second way is buying back stock. So if a company has 100 shares on the market and they buy 10 of them and expire those shares, then now there's only 90 shares of the company on the open market. And even if you didn't sell any shares, now you all of a sudden own more of the company because some of those shares were expired and you still own the same amount. So they're increasing your ownership in the company. And then, of course, they can be paying down debt. If a company is using cash wisely, paying down debt, improving their balance sheet, they're increasing their book value. And stocks don't move perfectly in line with all these things. Of course, there's macro factors every single day, but over time, it does even out. So I was looking in this shareholder yield fund. Doesn't have the best 1-year chart, and I think I know why. A lot of the companies and holdings here are really pretty small cap companies. But going down the list, Aflac is in one of our models. So I thought, you know what, let's take a closer look. How much money, how much cash is Aflac really returning to us shareholders? That's why we hold this company. So let's look at their shares outstanding. Well, first, dividend yield. That's that first one. They're paying us about 2% a year. That feels nice, but 2% a year doesn't feel amazing, but it feels nice. All right, now let's go look at shares outstanding. What's going on with that? So shares outstanding, if we just look at a 1 year, shares outstanding have gone from, let's call it 590 million down to 560 million. Well, that's a few percent. So they're giving us a few percent there. Our ownership is increasing just by owning the stock. Let's look at one more thing. Let's look at total liabilities here. So total liabilities over time here. We would like to see total liabilities going down. Well, it has gone down in the past year. Let's look at a 3-year. Those total liabilities are falling. So, I get this question a lot from people who are scared to invest. It's how I know the S&P goes up over time, but how is it magic? What's happening? And a lot of people do understand if revenue is increasing and margins are staying the same, especially if revenue is accelerating or something like that, then that company is going to grow. Their market value will grow. But that's not the only way that a company can force some growth into that share price. So there's other things we can look for. If we own high quality companies that pay us reasonable dividends, they buy back their shares, they're decreasing their debt, improving their balance sheet, and we can see those things, every quarter, it gives us a lot of confidence in holding those companies.
Fantastic. Thank you. Yeah, there's a lot more to it than just looking at the dividend yield. And, obviously part of that is reflected when they do those things, the stock price goes up, which we're familiar with that, so it's kind of like two ways to make money, dividend yield and stock appreciation. So
yeah,
awesome.
Mike, I really just wanted to, because investing can be scary. It really can. And the more you know, then the better equipped you are to understand, hey, on August 5th, Aflac or whatever was down 3%, just like the rest of the market. But I know that company is doing everything they need to do to add value for shareholders. So I feel comfortable and confident staying invested through good and bad times.
Fantastic. Well, thank you, everybody, and we'll have a great day.